During the shutdown, the Dow rose more than 10%. Let's talk more now about this and what else matters to the markets. Chad Morganlander, portfolio manager at Washington Crossing Advisors, not taking anything away from the economic impact and the impact of those families, 800,000 people, no paycheck for a month.
Awful.
The market didn't care. Why not? And do you think it'll care this time? Because if we get there.
Brian, the market is a forward-looking pricing mechanism. They're looking at 18 to 24 months. They look at this situation as if it's transitory. Now, of course, it's awful for the people that had to stay out of work and whatnot. We do believe that. But overall, it does not affect the U.S. economy a great deal. It may take 0.1% off of GDP growth for a quarter or two. But rather, it's not going to have long-term.
Let's say it took 1 or 0.2% off the last shutdown. Let's say, and let's hope not.
Right.
We shut down again. There's another tenth or two. At some point, doesn't it matter?
It would if this would go on for about 6 to 9 months straight. But overall, investors as well as economists believe that it's going to be back-end loaded and that those people that were shut down and it just disturbed their lives would actually go out and actually buy.
Do you think that the last government shutdown, and hopefully we avoid this one, but let's say we didn't last time, we shut down again, will it get the Fed's attention? Will that influence Fed thinking?
No, what's going to influence Fed thinking is the financial stability of the overall system, the U.S. economy, the jobs market, as well as inflation. But overall, that's not one of those critical things at this point in time that the Fed talks about in great length.
You guys at Washington Crossing Advisors have this thing called the Fundamental Conditions Barometer. First off, you need a new name. Come on, you got to get a marketer in there. But either way, it's a great indicator sort of how things look to you and your team.
But
so how do things look to you and your team?
Yeah, we're looking as if you want to be more cautious at this point.
Like cash under the mattress, kind of a cautious?
You want to extend your durations. We think the U.S. economy as well as the global economy will continue to soften, which would be one of these issues where you may see a seam of opportunity within the long end of the yield curve. We created this dashboard to actually get a better feel as investors on where to place money in relationship to, say, equities in relationship to, say, bonds. And overall, the 30 indicators that we look at, 10 of them of which are credit indicators, 10 U.S. economy and 10 that are foreign, are indicating to us that we're going to see a continuation of a deceleration in the global economy.
I'm easily startled. I'm a total coward. I mean, here's the thing. When I see the stock market going up and bonds being bought, somebody's going to be wrong, I think.
Well,
what is that telling us that both are getting bought, other than there seems to be a lot of money out there?
Well, Brian, the market has moved in a rapid fashion because of monetary repositioning. We all know that. The Federal Reserve went from hawkish to dovish. But the economic backdrop and all the markers that they're looking at are actually moderating. Look at auto sales, for example, or in the United States, the housing market. Those are big ticket consumption items that are showing this actual evidence of a slowdown. Also, look at corporate earnings. Corporate earnings have not been as robust as everyone was hoping for. And then when you go out and further and you look at the conference calls, they're concerned about margin pressure, gross margin pressure, or future revenue growth going out into 2020.
But we just had one of the best Januaries in stock market history.
Correct.
I know we're bouncing off this horrible December, but we've come up.
Yes, you have come up.
Stocks have... All the stuff you're saying is accurate, of course, and the bond market is reflecting that. But what is the stock market reflecting then?
The stock market is reflecting monetary policy. It's also reflecting at least a moderate increase within GDP. Our expectations are not for a recession, but overall that the GDP number for 2019 could be 2%.
I can't let you go before I ask actionable advice. You said extend your duration.
Correct.
Okay, that's fancy talk.
Yeah.
What does that mean from our viewers' perspective? What do they do now?
So investors are mostly scared about bonds because interest rates are so low. But in fact, we believe that the long end of the yield curve, interest rates can continue to grind lower. So we would not be surprised to see...
So bonds stink. Don't buy bonds.
No, I would actually buy bonds.
Treasuries?
We would buy treasuries.
At 264?
264, you could see that at a 225
basically,
later
with
this year.
inflation, no real return.
Well,
Zilch, I think, is the technical term.
But overall, you can get a fair return in 2019 from along in the yield curve. Also, on the equity side, you may want to position yourself into utilities, healthcare, as well as staples at this point.
When I hear a stock guy tell me bonds look good, I want to jump under the table and get in the fetal position.
Don't worry, it's not going to be that bad.
Well, let's hope not.